Hey guys, quick announcement here before you dive into today's show. We just locked up 3 individual assets that are all off-market, direct-to-owner deals that are going to help our partners and you, the podcast listeners, generate a ton of cash flow and build legacy wealth. And so I just wanted to take a moment to drop in here and invite you to a webinar that I'm going to be hosting on Tuesday, May 18th. And we're going to walk through each of these respective investment opportunities. One of the big reasons why we're doing this webinar is because we've had a ton of questions about parking lot investments here over the last couple of months. Now, as you know, we've been doing mobile home parks for nearly a decade now, and most everyone understands that business model. However, many of you probably know little to nothing about parking lot investments and the incredible opportunity within this niche. Now, one of the 3 deals that we're going to cover in this webinar is an institutional grade Class A parking facility located right here in my backyard of Clearwater Beach, Florida. Now, for those that aren't aware, Clearwater Beach has been ranked the #1 beach in America multiple times, and it's where I've called home for the last 2 decades. And so really no one knows this market better than I do. The Tampa Bay MSA is one of the fastest growing markets in the country and is on absolute fire. And so I'm super excited to share these opportunities with you guys. And so if you'd like to learn more, please go over to sunrisecapitalinvestors.com/webinar to get signed up, and I'll see you there.
You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investment. And our guest for this week's show is nationally recognized securities attorney, Gene Trowbridge. Now, Gene has been in the commercial and investment real estate business continuously since 1972 and in the legal profession since 1996. He's a member of the California Bar, and as the founding partner of Trowbridge Law Group, LLP, Gene's law practice concentrates on the syndication of commercial and investment real estate through both debt and equity. Now, as a former syndicator himself, who for 10 years raised investor capital, he served as a sponsor of 16 investment groups by raising equity from investors through registered representatives in the broker-dealer community, once sending out more than 1,600 K-1s in a single year. He was responsible for the organization of those investment groups, the acquisition, the management, and disposition of the real estate, and communications with investors. And so with that, guys, I'm excited to welcome back after, I think, maybe a 3 or 4 year hiatus of having him last on the show, Gene Trowbridge. Gene, how you doing today, bud?
I'm doing fine, Kevin. Thanks for having me back.
Thanks for coming back. It's been a long time. I didn't look back to see the year, and I tend to, when I say it's like 3 or 4 years, it's probably been 5, but I didn't look back to confirm the time frame there. But in any event, excited to have you back here. A lot surely has changed since we probably last had you on the show. But for those folks, Gene, that aren't familiar with you, that don't know who you are, that don't know your background, what have you, maybe take a few minutes. I'm going to pass the mic back to you and tell us a little bit more about yourself, ultimately how you got into the real estate space, and again, practicing law with a focus on securities law, if you would.
Sure, Kevin. Well, I think my career has had three chunks to it. I came out of college with an accounting degree, and I went off to sell real estate, and I sold commercial real estate for a while. And then I, like so many of the people that I work with, I started buying some small investment properties myself with my own money. And then I found a property that was a little too big for me to buy with my own money. So I went out and grabbed a couple friends, guys I'd gone to college with, and did my first syndication. I didn't even know what it was, and kind of like that. And that really led me off to about 15 years as a syndicator. And that was good, and I liked that. But somewhere along the line, when you mentioned that I sent out 1,600 K-1s, in the days I was syndicating, there were no back office companies to help you do all that. You did it all yourself. And so, I spent, it seemed like months licking stamps and licking envelopes and sending out this stuff. And I said, there must be something else to do with the last the last 15 years of my career. So I always tell the story. I went home and sat around the kitchen table with my wife where all the great decisions in life are made, And I said, what am I going to do for the last 15 years of my working life? And I said, I don't want to do this anymore. And so I decided I'd go to law school. And Kay was working. We had kids in school. I was still working. And I went off to law school, and I became a member of the California Bar in 96. And so that was 27 years ago. My 27 years ago, and I'm still doing it. And each of my previous careers, selling real estate, being a syndicator, has made me ideally suited for the way I approach securities laws. I'm a mentor. I do a lot of educational-based marketing, and knock on wood, we do an awful lot of business, and I'm proud of that, and I'm going to keep on doing it for a while.
That's fantastic. You've definitely made yourself a name in the real estate space. So congrats to you. I mean, your marketing's all over the place. I mean, you do a phenomenal job. And so folks should definitely be taking lessons from what you've done in the past historically. And, back to the, going off to law school later on in life, I'm assuming that you probably, you knew in the back of your mind with your prior real estate experience that you were going to go in and focus with an emphasis on real estate law. Was that the plan, or did you not know?
Securities law, period.
Okay. Got it.
I didn't take one class in law school in 2.5 years. I went kind of full time, but 2.5 years, I didn't take one class where they mentioned the word securities. So, but that's the only thing funny. I knew I was going to do. And I came right out into a private practice where I was alone. And I've had a few partnerships over the years, and I'm still in a partnership, but every partnership I've had has always started with the name Trowbridge. So I've always been the managing partner, and I've always usually attracted people to me who want to be mentored, who want to learn. My current partner, Jonathan, is, he's 40 years younger than I am. And he's been out of UCLA Law School for a while and been working with me. And, he had some opportunities to go with some bigger firms. And I just was introduced to him, and we started talking, and he wanted to mentor. He didn't want to go with an 80-member law firm where he's going to be a clerk for 10 years. And here he is now, 5 years later, he's a partner. And it's exciting for him and his wife, and it's a good relationship. So, that's what I did. And I haven't done anything else other than securities law since I hung up my my plaque.
Got it. Okay. So, just to give the listeners a sense of context here, we're recording this on January 26th. And so, just a very short time ago, we brought a new president into office, President Biden. And so my question for you, Gene, is are there any proposed changes that you see as you guys follow along with these things that you see coming down the pike with this new administration in office that will ultimately affect us syndicators?
Well, let's talk about the securities laws. The securities laws first. There's been a rush in the last 2 or 3 years of proposals coming from the SEC, and all the proposals are designed to improve the process of capital formation. And the last one came out that's finalized. And in practice came out on December 8th, where they changed the definition of accredited investors and expanded it to people looking at their experience rather just their net worth and their income. And now there's a proposal out there that we're waiting for approval, and then we're waiting for publication, which might change what we can do with finders. There's a real issue about having people who don't have securities licenses raise money for you. And right now, you really can't do that. And you certainly can't pay them. But if this finders approach comes out, we'll be able to have people introduce clients to my clients who might have some interest in investing. I don't think they can get paid for it. And I don't think they can do much more than just simply introduce people. But that might promote some capital formation. I got to tell you that the last statistics that are out from the SEC, and they're about a year old. There should be new statistics coming out in March. Said that during the last 12-month period that they researched, and this is all from the Form Ds that we filed, private placements was a $1.8 trillion marketplace. That's 5 times the amount of the IPOs that came out on Wall Street during the same 12 months. 1.8 trillion.
Wow.
And we are talking a lot of investors. Now, it certainly isn't all real estate. But, and I know we're going to get into this later, but I'll just say it now because it'll bear repeating. 99% of that 1.8 trillion is Rule 506, Regulation D, Rule 506, and 93% is 506B. Interesting.
That is interesting. Yeah.
Yeah, we'll talk about that a little.
I definitely want to broach that subject. But yeah, now that's surprising me. That's incredibly surprising. I would have argued that more than likely it'd have been C, not B. But we're going to touch on that, obviously.
Back to your question. So unless he changes the makeup of the SEC, the directors, I think clearly from the Jobs Act in 2012 until now, they've done nothing but promote our ability to raise money. So that's one thing. Now, the other side of the coin might be taxes. Is there going to be a change in tax law that's going to affect a real estate investment? And one of the things that might come out, they still are attacking 1031s. They still would like to do away with 1031s and tax deferral, or at least limit the capabilities of being able to use 1031s. And that might affect us a little bit. But I really don't see any big change. I think we're off for another very, very strong year of capital formation during the first year of the Biden administration.
Speaking to the finders of the proposed legislation regarding the finders, let's hit on that topic a little bit. That's something that is fairly relevant that you see on Facebook and LinkedIn and what have you. Folks that are helping, I guess you could say, helping raise capital for a real estate syndication. And
all those people that are doing it illegally, is that what you're talking about?
Well, I guess let's define what makes up an illegal action versus an legal action. What capacity do they need to be part? If they're part of the GP, does that make it legal? Or if they're not, then I would say that absolutely it's illegal. But please help us define what's legal and what's not legal.
In real estate, there's something called for sale by owner, Kevin. And so you can sell your own piece of real estate, but I can't sell yours unless I have a license. And in securities law, it's pretty much the same thing. It's called the issuer exemption. So as you mentioned, if you're a member of the manager entity in an LLC, you can sell people shares in the manager in the investment LLC. That's okay without a securities license. But if you're not a member of the manager, then you'd be treated as an unlicensed broker-dealer, which is illegal. And secondly, if you get paid, no matter where you are, if you actually get a commission, the term is transaction-based compensation. If you get a commission, you don't have a license. That's illegal. So, I saw a deal not too long ago, Kevin, by someone who you would know if I mentioned it. And they had a managing member LLC with 18 members. And each of those members was getting a share of what the manager makes. And they were each responsible for raising money. And he actually had a contract with each of them telling them how much money they had to raise. And if they didn't raise it, then they wouldn't get the percentage that was set out when they started. And that is just totally illegal. And so I rail against that. I rail against that all the time. But if we go to finders, it might open things up. I do know. I mean, it hasn't been passed yet, so I didn't study it a lot because there's everything always changes after they get public comment. But usually, a finder can't really say, Kevin, this is a really good deal. I've analyzed it. Look at the cash on cash. Look at the loan terms. Look at the rent rolls. You can't really do that. You can just say, Kevin, I know Kenny Wolf, and Kenny Wolf does good deals. And if you're looking to invest in Texas, maybe you should give Kenny a call. Period.
Got it. I'm assuming that the brokers dealer network is probably lobbying strongly against that finders to be enacted, but maybe not.
You'd think so, yeah. And that's kind of interesting. Back to 506B and C, a lot of my clients do, and that's how I raise my money, make arrangements and sign selling agreements with broker dealers, but they will only do a 506B. They don't advertise because they've got this database, this Rolodex of all these investors that they already know.
Yeah.
So they don't want some sponsor going out there and advertising and breaking the law. So they'll just 9 times out of 10, the selling agreement says no advertising, 506B.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my 2 podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche, and that's the phenomenal niche of mobile home park investing. Now, for those that don't know, I've been a full-time real estate investor for more than 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in Growth and Income Fund 3. When you invest in our fund, you get immediate diversification into multiple deals we acquired off-market that are already performing and have built-in sweat equity. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please visit us at investwithsunrise.com and request access to the investor presentation. It's absolutely free, and you'll get instant access to review the off-market deals that we've already purchased that you can co-own with our team. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-227-4359, and our investor relations team will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule the call. Let's jump on the phone. And with that, guys, I'd like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
So in my mind, and please correct me, I guess in my opinion, the only benefit between a 506B and a 506C is the ability to raise capital from a small batch of non-accredited or sophisticated investors. Is it 35 or 25? I always forget the
35. It's 35, Kevin. And all the accredited investors you want, and up to 35 sophisticated investors. There's no dollar limit. And that's where almost everyone starts. Kevin, I'll tell you, because on your first deal, I'd be investing based on Kevin, not so much on the property. Mm-hmm. And if I don't know Kevin and I'm just answering an advertisement, it's unlikely I'm going to send you a check for $50,000. Okay, but 506C is used in my world by quite a few newer syndicators because it does let them advertise and it lets them build their database. I have an offering right now where the client is only raising $700,000 and he's doing a 506C because he's going to advertise for 90 days, advertise the hell out of it and get names and build his database. And then develop a relationship with those people and then come back and do, a 506B next time after he has them in their database. So there is a strategy there, but I think the figures were out of the 1.8 trillion, 1.4 trillion is 506B and 210 billion is 506C. So it's, it's seven times.
That is still very shocking. So I think of if you're doing a 506B, that means you've got assuming you have a list, you have a network, an existing network of folks, and proportionally speaking, we're talking about a or a B capital raise, 506B capital raise. Again, only 35 of those individual investors can be non-accredited. And so one would make the assumption that those 35 more than likely will probably, on average, invest maybe less capital per individual than that of an accredited investor. Maybe I'm making the wrong assumptions here, but and so really the only benefit then is if you don't have a deep enough network of accredited investors and you need to bring that capital in from maybe other folks that are non-accredited. And I'm
well, I think
those
you're
that,
right.
Yeah. I guess we went to 506C in the first round only because we had a list, but also just I saw the value in being able to again reach a broader base and at least start building a relationship with them. It might take a couple of years before they ever invest, but take the time, take the benefit of that general solicitation opportunity and actually start building that rapport that we all know takes a lot of time. It takes plenty of time to build that trust and that rapport with an investor before they go drop a $50,000 or $100,000 check with you. And then we got the A+ offering. Let's talk about
Kevin,
that.
That's okay. That's for Grant Cardone, and that's if you want to access non-accredited investors. I went to his 10X conference. It was a year ago, February, and in Vegas, and there were like 12,000 people in the auditorium, and he had people walking down the aisles handing information sheets on his A+ offering, which we did. We did his legal work for that. That's fine. But that's not for everyone. But you can see I've got someone who's been dancing with me about being a client, Kevin, who has a YouTube channel, and they say they have 80,000 subscribers. Okay, that's the perfect person to do a 506C, so you can stand up in front of all of those people and say, here, buy my deal, but you can only take the ones that are accredited. It's also perfect for a Reg A plus. You can take anyone. Okay. But the scary part of a Reg A plus is the time it takes, the dollars it takes to get it, and the fact that you're going to have a bunch of non-accredited investors. And anyone who's done any syndication knows that the smaller the investor, the more trouble there is. So, and then I'll just tell you one more thing, and we're spending a lot of time on this. My most prolific client, I've done 121 offerings. Wow. With this client since 2014, Kevin. 506B, accredited investors only, and his investor pool is closed. He doesn't take any new investors. And so he doesn't need to advertise. But what stopped him from going to C is that if you've done 100 offerings, you probably have a bunch of and everyone's accredited. You have a bunch of people who are used to just checking the box. I'm accredited. Don't be going to them and asking them for their 1099, their W-2, their 1040, their balance sheet, and put them through the ringer of being accredited through a third party. They're not going to do that. That's
a good point. That's a good point. That I could see being an actual, a wall, somewhat of a brick wall that might cause some challenges with that pre-existing network if they've got to go through those steps each and every time that a deal rolls out. So that
and that accreditation is good for 90 days, Kevin.
Yeah, no, that's valid. That's definitely a valid point. So let's talk about. I know that you coach other attorneys, but you also you have a lot of different content out there, and you're really out there educating new syndicators as well. Really, helping guide them down the right path to avoid a lot of mistakes that new syndicators ultimately could or might make. And so, what do you see as being some of the bigger mistakes that new syndicators make? Like if you pick like the top 3 that are absolute huge no-nos, I guess aside from those that might be the finder people that we're talking about here, I want to separate that from the conversation. But syndicators themselves that are again looking to structure a 506B or C or maybe an A plus, what have you. But generally speaking, what are the biggest mistakes you see?
The biggest mistake is trying to draft your own documents. Literally, Kevin, I have people who come to me and say, I've worked on drafting my own PPM. Will you take a look at it? And many times it's my document.
Oh, boy.
And so generally I just say no. It's easier for me to draft a document from scratch than it is to try to figure out in your document from another attorney when he says Article 4, what the hell is Article 4? Now I have to read it, So do it yourself is a big problem for beginners because it's going to cost, as $10,000, $15,000 up front to get your legal work done, and you've already put $100,000 out in your non-refundable escrow deposits. So you want to save some money, and I guess there's an argument that you're saving the investors money if you can get it done cheaply. So doing it yourself is a big one. Number 2, not giving yourself enough time. By the time a client calls me, and then I look at when the closing is, we really need, 4 to 6 weeks from the time I get started until they close. Because most of us can get the work done in 2 or 3 weeks, which would give you 4 weeks then to actually collect the money. Not all the money comes in immediately. Even if Kevin, you've said to me, I'm going to invest with you, Gene, and then I bring the documents to you, you might be right in the middle of setting up your self-directed IRA, and that's going to take a while. You might be getting ready to go on vacation. So it takes a while. So you've got to give yourself enough time. And then my favorite mistake is not reading the documents that the attorney gives you. You've got all your money in escrow. You've hired the attorney. You're all ready to raise money. The closing is getting closer and closer and closer. And I send you all the documents and you just run. Well, you broadcast it 500 times on email, which is a definite mistake, but you run out to the investors and you try to raise money. And by God, Kevin, someone is going to ask you to explain Article 4.2, and you have no idea what's an article. What do you mean by Article 4.2? Not reading your own documents. I tell people, here are the documents. Will you just take tonight and read the documents? You know what they say because we've been talking about it all along, but you don't know where it says it. Because Kevin, you're going to run into an engineer.
Yep.
And the engineer is going to want to read every word. And if you don't know your documents, you've lost that investor for good, probably.
As you should. If you don't know the answers to the questions.
Now, going on, I'm going to tell you the mistake that I made. Here I have these broker dealers out there who are raising money for me. And there's a lot of sponsors like Gene out there, and broker dealers are raising money for them. So I was under the opinion that if I didn't have an offering on the street all the time, that the broker dealer would go to Kevin and do Kevin's offerings, and then I'd never get that broker dealer back on my team again. So a mistake is thinking you always have to have an offering on the street, that your investors will leave you if you don't bring out an offering for 6, 8, 9 months. That isn't true, but that's what you think. And the deals that I did 2 deals that were problematic. Were both the mistake was I jumped at them too fast because I thought I really needed to have a product on the street.
Very interesting. Do you see that a lot of new syndicators actually working with that broker dealer network?
No, I see a lot trying. Mm-hmm. I mean, if you don't have 25 million under management and haven't done 6, 8, 9 deals, you won't get into them. I'm all for talking to them and showing them what you're doing, even though they won't do this deal or even the next deal. By the 3rd deal, they might be interested if you take them along with you and show them that you're successful. I always found that the broker-dealer community liked my offerings. I was building storage facilities. I was building storage facilities in Southern California, so it was local. And I had $100,000 investment minimum back in the 80s. And they had investors who wanted to invest in equity funds that would build their equity. They didn't need a check every quarter to buy groceries. And all the big partnerships that were out there selling their public funds were not attractive to these investors. So if you have a product that the local broker dealer thinks he's got some high net worth local people, I think you might do well.
Well, I think it just goes back to, you might not have said it in such words, but, just a track record and really proving your concept, jumping into the space, not having a track record, not having a deal that's gone full cycle or a few deals that have gone full cycle. It's going to be very challenging to gain that trust from that broker dealer that ultimately has spent a lot of time gaining the trust of his investors, right? Of his network of folks that are looking for capital on the deals. And so that's his reputation. You only get one chance.
And that's what I do. I do a lot of education for CPAs. Mm-hmm. And I always ask them the question, would you recommend a client syndication to one of your clients? And the multiple choice is no. Only if the syndicator was actually my client also. Mm-hmm. Only if I'm willing to invest. Mm-hmm. And most of the people, they don't want to recommend your deal, Kevin, because if your deal goes bad, they're going to lose that client.
Yeah.
So it's difficult.
Absolutely. I'd love to switch gears if we could, and I want to be respectful of your time as well. Make sure that we cover all these bases before we say goodbye. And so I'm going to switch gears. We're going to go to the other side of the equation, which is the limited partners, the passive investors in the deal, the ones that are for the most part putting probably the majority of the equity or debt, depending what kind of structure you've got into any one given deal. And so, again, there's lots of different options out there. We were talking about this before we started the show. There's, just like podcasts. You do a podcast, I do a podcast, and 10 years ago there weren't many, right? It was a handful. You weren't overwhelmed with choices. Nowadays, there's a million and one real estate podcasts out there, and I'm just pulling that number out of the air, but there might be more or less. Not sure, but in any event, there's lots of choices. Choices lead to getting overwhelmed. And so, what's the advice that you would give passive investors, limited partners that, let's make the assumption they have not been acting as a limited partner for the last 2 decades, right? They're fairly new. They've got decent net worth. They've got capital they'd like to deploy with, a trusted sponsor that's got a track record. And so, how do they go about sifting through all those options that are out there and, really focus on making the right choice with the right sponsor, with the right team?
Well, I'm going to break it down into two parts. I think one is the asset class. Mm-hmm. I think the investor needs to take it upon themselves to get knowledgeable about mobile home parks, self-storage, multifamily. They need to have some education on the real estate. And I'm not actually sure that that's the syndicator's responsibility to give them, to educate them on real estate. So I think you have to, and I'd really like to set that aside. Number one, don't invest in patent pending solar panel business that you don't know anything about, what, and that goes to the definition of a sophisticated investor. A sophisticated investor is supposed to be smart enough to understand what the offering is about. Mm-hmm. Okay, so I guess sophistication means different things and different offerings, right? So anyhow, so let's put real estate aside. I think you owe it to yourself to be knowledgeable about real estate. But I've got 4 questions that I tell everyone. I teach this all the time, and you're not going to believe how simple these 4 questions are. First question is, Kevin, I like your deal. I've got the $50,000. Kevin, if I give you my money, what happens if something happens to you?
Mm-hmm. Okay, yeah, that's a great one.
So I'm telling the investor, read the book, read the private placement memorandum, and find out who the manager is. If the manager is just plain Kevin Bump, run. Don't invest, because all sorts of things happen to individual managers in an LLC. It might be an LLC, but if there's only one manager. I've been the replacement managing member 6 times in my career for people for whom things went bad. One death and other things. And, that's happen. Devastating to the members. First question. Mm-hmm. Number 2, Kevin, have you done this before? And Kevin, you and I in our syndication career have always had to answer that question at least once. No, I haven't. But, and you better have a story of what is your real estate background? What leads you to think you're ready to take someone's money and invest it in real estate? What's your training? That's pretty good. Number 3 is, Kevin, are you going to invest any of your own money in the deal? Where does it say that in the PPM? And I used to think, Kevin, that it was just cash. How much cash? But, all the syndicators sign notes. They sign mortgages. So I think skin in the game has 2 components to it. Are you signing on the mortgage? Is it recourse? Is it non-recourse? And are you putting up some cash in the deal? Yep. I think that would make me feel comfortable if I was, going to be a member. And then the last question is, Kevin, if something happens to me, how do I get my money out? Mm-hmm. And Kevin's going to say, well, we have a professional draft our operating agreements, and in Articles 11 or 12, hopefully you can say that, in Articles 11 or 12, we have 2 provisions for liquidity. One is voluntary liquidity and one is involuntary liquidity. And I think we should go over those together and see that you'll see that there is the ability for you to get your money back. Okay. And you notice in those 4 questions, I didn't say anything about cap rate, NOI, cash on cash, holding period. I didn't say anything. I think that if you had those 4 questions answered to your satisfaction, then you can delve into the PPM and you can now start talking about the real estate deal.
Yeah, I mean, at the end of the day, I'm a firm believer that you're first and foremost investing in that sponsor.
Absolutely.
Because you could take a phenomenal deal. What all of us might define as a phenomenal deal, right? It's subjective, but you take a phenomenal deal and put it in the hands of a poor operator or sponsor, it's no longer a phenomenal deal, right? Or you could take a mediocre deal and put it in the hands of a phenomenal sponsor with a track record that's been there, done that. They've done it 10 times over again or 20 times over, and they can take that mediocre deal and see value and opportunity where others might not have, and extract that value. So,
I think you're right, and I think rookies are particularly in trouble finding investors to pull the trigger if they don't know that investor.
Mm-hmm. Yeah, I want to back up a little bit. You mentioned about for the LP side, understanding the asset class that you're investing in, educating yourself on the asset class, and that I agree that it's not necessarily the sponsor's responsibility to educate them. But what I would suggest, and something that's worked really, really well for us, it wasn't the reason that we started it. But aside from this podcast, I also have a mobile home park investing podcast that I started somewhere 4.5-5 years ago, give or take. And what I found after speaking to a litany of our investors over the years is that a lot of them might have originally either met me at a conference or through this particular podcast, which has a much greater audience. But one way or another, they came through an outside venue, and then ultimately, a large percentage before they actually invested with our group, they started diving into the Mobile Home Park Investing podcast. They dove into there and literally spent time. We did many different shows earlier on where we went very granular into our business model, the SOPs in our company, deal specific overviews, what have you. And they use that as a way to not only educate themselves, but also get a comfort level that we knew what we were doing, that there truly was some proof of concept there. At least theoretically, there's proof of concept because we're talking about or walking through individual deals, what have you. And so again, maybe that's a tidbit of advice for those that are listening, that if you're just getting into the syndication space, could be a great opportunity, or I guess not necessarily the syndication space, but if you have a little bit of a track record, you're looking to raise capital, maybe spend time and put together that content on the particular asset class you're investing in, and go through particulars and get granular in deals that you've done already or that you're going full cycle on, what have you. And I think that inevitably will become that education piece, and it adds another layer of value to your prospective investors.
Right. You're absolutely right, and you and I could name organizations that you could go to learn about multifamily investing, to learn about mobile home parks, to learn about self-storage, and now, of course, senior living. All sorts of people out there now talking about senior living. I got my real estate. I told you I started selling real estate, selling houses, and then somewhere along the line, I ran into someone who told me I needed to take a CCIM course. So I took a CCIM course and got my CCIM designation and went off and taught CCIM for 40 years. And that's where I got all my knowledge about real estate. But when I decided to build storage, I didn't know anything about pouring concrete, which is what you do when you build a self-storage facility, And so I had to learn about that. So I think it would behoove the investor to take educational programs in the asset class. And I tell my people, I have a deal I do that's called Sell the Sizzle. And I tell them what you need to do in building your database is, first of all, find people that are interested in real estate. Mm-hmm. If they're interested in Bitcoin, they don't need to be in your database. Real estate. Then decide what area of real estate are you an expert? What can you bring value to? And then figure out in that area, what are the opportunities that you see? And so then you're building your real estate people into the opportunities that you find in mobile home parks today. What are the opportunities in buying existing mobile home parks and upgrading them? And then the third thing I think you have to do is you have to be able to sell the sizzle of your team. I've assembled a team that will let us take advantage of the opportunities that we see in the mobile home park community. And so far, I haven't even talked about my offering yet. Okay.
Yeah.
Because too many of us go backwards. Hey, I got an offering, Kevin. You got to buy it. Well, what is it in? Well, it's in mobile home parks. Well, who is it? And you go backwards. And you find out they're not even interested in real estate. So you've got to build, from real estate to mobile home parks to me managing your money. And then when you take the offering out there, one thing, they're ready for it. And two, you've got yourself a substantive relationship, a pre-existing substantive relationship because of the way you built that relationship with that investor. And here we go, 506B.
Yeah, no, absolutely. I agree with you. And again, tying back to proof of concept, you get the question a lot, and the suggestion I give to folks that are getting, even if they're speaking to the folks that are just getting started, like they literally haven't even done a real estate deal yet, and they're talking about raising capital. They've never done anything with even their own money. I suggest that they go if you want to be a multifamily, when you do big multifamily, maybe go risk your own capital first. Go buy a 4-unit complex. But if you're going to be a value-add investor, go go find an opportunity, uncover an opportunity in a 4-unit, something small enough that you're not going to go hopefully completely bankrupt if it doesn't go the right direction or go south. And risk your own capital first. Execute on your plan. Document the entire process along the way, and then use that as a point of conversation with prospective investors when the time comes where you have a larger offering that you're putting out there to the public place. So,
and I'd suggest that they invest passively into some
there you go
proven operators offerings, so you can see how a proven person does it. I think that would be that would be strong. I was talking to you earlier about this interview process that I'm going through with people who are in the business, my clients and not my clients and everything. And the last question I ask on the interview is, what advice would you have for rookies? And I would say 15 of 16 of them said, this is not a do-it-yourself, do-it-alone business. You've got to have a team. You've got to work with other people. And I think that's absolutely right. First of all, you already know that I'm a strong believer in having continuity in case something happens to you. But the other side of the coin is you're not good at everything. I had my team was me. I could find the deals. And then I hired a guy who could pour cement. And then I hired a property manager. Yep. So I couldn't do all three of those things. So there were 3 of us in our manager group, and we covered all the bases. I put people together in teams. When I do live meetings, I find someone who's a property manager who wouldn't know a good deal if it hit him in the face, but he knows how to write reports. And I found a broker who knows good deals, but he doesn't know how to draft a purchase agreement. And so you put them together and they're a team, So I think you probably agree with me. I hope you do that.
Absolutely.
Having a team is I was surprised. I thought more people would go toward the education and the asset class. But 15 of 16 said it was the team.
Yeah. We can't do it alone. If you think you can, then you're probably not going to be in the business very long. You got to learn how to work with others. You have to learn how to identify what your strong suits are. What are the unique skill sets that you possess that you do better than anyone else, and then find those that have the complementary skill sets, not the same, but complementary, that can kind of make up the final ingredients of that team. Gene, I know you offer a lot of different educational resources. Again, you've been putting out phenomenal content for many, many years now. So maybe take an opportunity to tell the listeners a little bit more about, what you have to offer. I know that we talked about a program that you're offering for new syndicators. You're doing these interview sessions as well. Tell us where we can watch those maybe, and anything else that you have that you'd like to share. Thanks.
Well, first of all, I have a book that's available on Amazon. It's called A Whole New Business. This book is specifically written for real estate people who want to get into the securities world, which is a different business than real estate. You can find that on Amazon like this or Kindle. And right now on our YouTube channel, which is Trowbridge Law, we're showing these interviews that I've been doing with people that are in the industry. That's a pretty good educational place. The thing I'm doing right now, since we're all on virtual, and we're not doing any live presentations, which I've done over the years, I'm doing a rookie camp, and we do one a quarter. And it's 15 people maximum. And if I think you've done a syndication, you can't take my course. It's for people who are truly rookies, not in the real estate business, maybe, but maybe. I don't really care about that. But it's for syndication, and it's 2 3-hour sessions. It's always a Tuesday and a Thursday morning, 3 hours. Zoom, 15 people, very interactive, once a quarter. It always sells out. And you can find information about that at our website, trowbridgelawgroup.com. And we're going to be starting to market our February one here pretty soon. But anyhow, we do it once a quarter. Kevin, I built my business on education-based marketing. That's how I got my name out. That's how I got all my relationships in life, really in the real estate business, have been because I've been willing to share information, and then that relationship building has come back to me in clients. We've done quite a bit of business.
You've done a phenomenal job. No, absolutely. I mean, seriously, I remember when I was getting into the syndication space years back. I mean, you'll go to Google and type in real estate syndication or any variation of that keyword phrase, and Gene pops up. Gene's everywhere.
That's good.
That's a good thing.
You work hard on that. So thanks for letting me mention that. And if any of your people just want to follow up on anything that I've said, you can go to the website and schedule an appointment with me, and I'd be happy to talk to you. I get a lot of homework calls. I call them homework calls because before they get started, they want to talk. Well, how does this work? How do you work with a securities attorney? So I'm happy to do that.
Yeah. Well, fantastic. Well, Gene, it's always a pleasure having you. Thank you for coming on, and thank you for being so open and transparent and giving with your information and your knowledge. It's much appreciated. There are many hundreds of folks in this industry, probably tens of thousands actually. Thank you for everything that you've put out over the years. So it's been a pleasure having you back, and hopefully at some point here in the future, we will cross paths at a live conference.
That would be great. I'm missing those live conferences.
Me too.
I've got one that someone's thinking about doing in February that I've done every time they have a conference. And one of the 3 speakers has bowed out because they're not sure they want to go. I think I'm going to go.
Mm-hmm. I'm ready for it. I was okay for a few months of not having any obligations to go, travel. There's certain points I go through with. I've got little kids and all that. And I don't like leaving the family, but I also enjoy the networking. Right? It's kind of like a push and a pull. And so there was a period where I was like, okay, I'm okay not traveling for a while, but right summertime, I was ready to go back at it again, but we've been.
Well, Kevin, I'll reach out to you and see if I can entice you into going into one of my interview shows. So
please do.
Or something. Okay?
Please do. Well, Gene, thank you again for coming on the show. Great having you.
Thanks for having me. Bye.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.